have single or joint life. So if somebody is wanting term policy just on themselves, it'll be single. If it's a couple, you can get joint first to die or joint last to die as well. So the benefit, the death benefit, will be paid out either when the first person passes away or when the last person passes away on that policy. Now, keeping in mind, even though you do have options for joint life, you still have to stay within that term, right? So if the person has term until age 70, joint first to die or joint last to die, if none of them pass away until age 70, that policy is done. And if they pass away after that, it doesn't matter because that policy only covered until that particular age. So it is important that when we're looking at term, it might say joint first and joint last to die, but it's within that term only, right? So that is important. The death benefit, so DB here stands for death benefit. The death benefit can be level term. And what does that mean? That means that the term, that your amount is the same. So if your death benefit, the person has selected, let's say 500,000, it's going to stay 500,000 for as long as you have the policy. That's level, right? Decreasing term means that each year that 500,000 is going to go down. So you start off with 500,000, next year might be 480, next year might be less. So by the time the policy is done, then you kind of have no death benefit left. Why would somebody get decreasing death benefit? Why are you paying a premium and then your, the benefit is decreasing? Usually it's for something such as maybe a mortgage or some type of a loan. Something like that. That's usually the reason why somebody would do it, because the idea is if you get term insurance to help protect your mortgage, each year you're already making mortgage payments. So your total mortgage amount is going down, and the death benefit of the term is reflective of that. So it's just meant to cover the mortgage or a loan or some sort of obligation that you have that you're already paying off. So it's meant to sort of cover that. So that's usually when we get the mortgage, decreasing term. And increasing term is when the term is increasing. So this is for someone who's maybe worried about inflation. So they don't want that same 500,000 by the end of 30 years or by the end of, however long that they have the policy for. They want it to increase. So it might increase by a certain percentage every year to help offset inflation. And of course, premiums, so we talked about premiums are based on term, and if the person is getting level, decreasing, increasing, single, joint, so all of these things are going to make up how much is it going to cost per month for that particular person, because depending on what kind of a plan they want, their cost is going to fluctuate, right? All right, they also have options with term, options such as renewable or non-renewable. And again, one of the things with term insurance that we have to remember is that it does not go past usually age 70, 75, or 80, depending on the insurance company, but it will stop after that specific age of around like 75 to 80, then they don't cover you after that, right? So that's important to know. So even if you have renewable, it will stop after a certain age because the insurance company feels it's too high of a risk for them to take. So they will cut it off at that age, right? So it's not going to go past that age. Right, so you can have renewable. Renewable means that let's say you have renewable term 10 and you bought it when you're 25 years old until age 70. So you can keep renewing it every year until you get to age 70, every 10 years. So if it's renewable term 10, every 10 years you can renew that plan again. And up until age 70, at that point it will stop. However, your premium is going to be based on your new age. So it's not going to be still based on when you were 20. It will be based on every time you renew, however old you are at that point, it'll be based on that. So the premium will go up higher. But the point of having this feature is you don't need any proof of insurability. That means that if the person has developed some sort of illness or anything in those years, the insurance company can't turn them down. The price will go up because their age is going up, but they're still covered. Okay. The next option that term has is a convertible option. And that means that if you want to eventually convert it to permanent insurance, you can do that, right? So let's say you have your policy and you decide that you want permanent, which would mean that it doesn't stop at this age. It goes all the way until your full life. You have that option to do that, right? So you can add the convertibility option in there as well. All right, So that's term insurance in a nutshell. Now let's look at some of the advantages and disadvantages of this product and who should you recommend it to? Because when it comes to exams, questions are always scenario based. So they will give you a story of someone and ask you, what kind of a product should you recommend to this person? So for who is this product suited for? So this is for someone who has a limited time need. So they're not looking to leave something behind for their family. They're not looking to have insurance for the for the rest of their life, but maybe they're only looking to cover a mortgage, or sometimes they might be child support payments, obligations that they have to make until the child is 18. So they don't need it for the rest of their life. They just need it for that specific need. So someone who has a limited need, limited time need, they don't need to get permanent because it would be much more expensive. Or someone who doesn't want to cancel, because if you cancel with term insurance, you're not really getting anything. So it's not for someone who wants to cancel after a couple of years. It's the cheapest option for if the person is younger. So if it's for someone who wants it for only up until a certain age and they're very young right now, then it's a better option to get this than term because it would be much, much cheaper. So that's the ideal sort of person who fits better for term than for permanent. Advantages and disadvantages of this product now. One of the advantages is that it has a low initial cost. So when you're starting off, for people who are younger, it's going to be much cheaper than if they were to get permanent product, right? So if you're younger, it has a lower cost, which is a good advantage. It has guaranteed premiums. So that means that your premiums are not going to increase for the term that you have. If it's starting off with $80, it's going to stay $80 for the term that you have, right? So it's not going to fluctuate. It has renewable and convertible options. So you have options if you want to continue to renew, or you want to change your mind and you want to make it permanent. So you have that option. If you add that feature, you can do so. And you can customize it. It can be customized based on the needs. So if someone only needs it for 10 years, they can do that. If someone needs it until age 75, they can do that. If someone needs it for, whatever they need, they can do that, right? So they have the option to customize it based on their needs. So a lot of good advantages. Some of the disadvantages now for term is it's a limited time period. So if you have a client who's looking for permanent insurance that, because they don't know, like let's say their parents lived until they were very, 90s and they take care of themselves, or they try to do all of those good things. So they don't want something that's going to stop after a specific age. So they don't like that. So this is a disadvantage. Another disadvantage is that it's worthless at the end of the term, right? And what do we mean by that? That means that if they pay their premiums for 30 years, let's say they have a 30-year term, by the time those 30 years are done, the policy is worth nothing. They can't get anything from that policy. And what we mean by that, you'll see when we talk about some of the permanent products that have some better options for people. Those are important. That's why it's important that this person doesn't cancel, because if they cancel after 10 years, they're going to have nothing, right? So that's one of the disadvantages. And also another disadvantage is that it's limited to a certain age, right? So it stops after a certain age. You don't have that option. So those are the key sort of pros and cons in term, and this is how term insurance looks like overall. So this is it for this segment. In the next segment, we'll start looking at some of the permanent products such as whole life, and we'll do a quick comparison as well to see which client is better suited for which type of product based on their individual needs. All right, so thank you for joining, and we'll see you in the next segment.